For many Singaporeans, buying a condo doesn't just represent an upgrade in lifestyle, but is also a symbol of success and, more importantly, a reliable way to grow their wealth. Over the past 15 years, the number of condo owners have more than doubled, and despite sky-high prices and tighter financing rules, the demand for condos remains stronger than ever. But here's the million-dollar question. Is it actually a good idea to go all in on property? Or is it actually better to invest the money into the stock market instead? Let's find out in this video. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. To understand Singaporeans' obsession with condos, all you gotta do is look at the price trends of properties in Singapore. Over the past 20 years, the property price for private condominiums surged by over 300%. This translates to a CAGR of 7.5%. In contrast, HDB property prices increased by just over 160% during the same period, or a CAGR of around 5%. Indeed, if you are already planning to lock your money into property anyways, why not top up some extra money to upgrade your lifestyle and build your wealth at the same time? And so the term asset progression started becoming popular. It is a simple concept popularized over the years by many real estate agents. The strategy is simple. You first start off with an HDB flat, typically a BTO, to enjoy heavily subsidized prices and generous housing grants. After staying for the minimum occupation period, the flat can be sold at a profit. Then, with the proceeds and some additional savings, you upgrade to a private property. This move not only upgrades your lifestyle, but also accelerates wealth building. From there, if you want to, your partner has the option to purchase a second private condo under their name to be rented out for some sweet passive income. Then, when you eventually retire, you'll be able to downgrade back to an HDB flat and unlock all the capital gains accumulated over the years. This is such a genius idea because not only you get the profit of the subsidized housing and grants, but at the same time, by upgrading to a condo, you are positioning yourself for an even greater capital appreciation and rental income potential. So, how much value can you unlock by doing this asset progression? Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. For a start, assuming you aim for the most hot BTO locations and are lucky enough to get it. According to the data compiled by Stat Homes, the most profitable 4-room flats will net you anywhere between $300,000 to $530,000 worth of profits. This will easily double your net worth in just 5 years. From there, you top up some extra money to buy the next hottest condo. And assuming you are lucky enough to get it, and you bought and sold during the correct time, that will net you another 200k to 600k worth of profits, or an average gain of around 20 to 35%. But what does that mean for you? Suppose you own a typical 4-room condo in the OCR with an average resale price of $1.6 million. As you near your retirement, you decide to sell that condo and move into a 3-room resale HDB flat that costs around 460k. That would instantly free up $1.14 million cash. Now, of course, we haven't factored in all the additional costs like lawyer fee, mortgage interest, and renovation expenses. Still, for many Singaporeans, this is the ultimate nest egg because unlike HDB flats, where you are mostly limited to schemes like the Silver Housing Bonus Scheme or the Lease Buyback Scheme to extract value, the asset progression strategy gives you a far more powerful way to build wealth. And with private property prices pulling further and further away from HDB resale values, the longer you hold onto that condo, the bigger the potential windfall when you eventually decide to downgrade. But then, what about stocks? Over the same 20 years, the S&P 500 gave close to 425% return. This translates to a CAGR of 8.7% a year. This is slightly higher than the private property's 7.6% CAGR. However, when you adjust for the 21% drop in USD to SGD exchange rate during that same period, the CAGR from stocks starts to underperform private properties. So doesn't this mean that it's better to be a property huat gui than a stock investor? Not really, because this also largely depends on the time period that we are looking at. If we zoom out and look further back to 1995, private property prices in Singapore grew at a CAGR of just 4.41% over 30 years. In comparison, the S&P 500 more than doubled that, delivering an impressive 9.49% annual return over the same period. Even after accounting for the 11% depreciation of the USD against SGD during that time, the S&P 500 still delivered an impressive adjusted CAGR of 8.93%. That's a massive gap, and it highlights the real opportunity cost of prioritizing a private property upgrade while ignoring investing into the stock market. Now, don't get me wrong, my point in showing you all this isn't to ask you to forget about asset progression and go all in into stocks. On the contrary, I have no idea which asset class you will outperform in the future. If anything, analysts believe that the S&P 500 will deliver an annualized 3% return over the next decade, while demand for Singapore properties are expected to remain resilient as the population continues to grow. All I'm saying is that when you go all in into condos, you open yourself up to several risks. First, as you go up the asset progression ladder, you have over-concentration risk, especially if you can barely afford the condo in the first place. According to an article by DBS, you and your partner should have a combined household income of at least $12,500 to afford a $1.5 million condo. But in reality, that's just the bare minimum. At that income level, nearly half of your salary would be going towards loan repayments, leaving you financially stressed and highly vulnerable to shocks like retrenchment, rising interest rates, or sudden emergencies. Instead, if you check the household expenditure survey, the average monthly household income of condo owners is actually much higher at around $25,000. This suggests that in order to be able to comfortably afford a condo in the first place, you need to be in a much stronger financial position with far more breathing room. So if you're only earning half the amount and are pushing yourself to buy a $1.5 million condo, you are not really progressing. You are over-leveraging. When you do that, even a small financial setback can plunge you into a crisis. Next, not many people realize this, but if you think about it, a condo is actually a golden handcuff. On the outside, you may look successful with your atas home and swimming pool, but in reality, you can't afford to take a break or quit your job because you have to pay your mortgage and condo maintenance fee every month. And you will end up in a situation where even if you have a high-paying job, you are forced to continue working for another 20 to 30 plus years just to continue paying for your dream home, when instead, you could have just retired in 10 years. Is it really worth trading decades of your life for a single property? Probably not. And lastly, many people who pursue asset progression do so with the assumption that one day they'll be able to downgrade their property and live off the profits in retirement. But there is never a guarantee. Just look at Japan. Back in the 1980s, people believed that property prices would keep going up forever. But then the bubble burst, and decades later, prices in some areas still haven't recovered to the previous highs, and there are now over 9 million empty homes in Japan. Now, I'm not saying that will happen to Singapore, but it's worth remembering that no asset class moves in a straight line forever. There are plenty of factors that can cause housing demand to soften here too, such as decline in population growth, rising interest rates, or even policy shifts that can change the economics of owning private property. And if that day ever comes, the people who stretch themselves to upgrade might find that their supposed retirement plan might not plan out the way that they expected. But then you might ask, won't the same thing happen to stocks? Yes, just like properties, stocks aren't risk-free either. The dot-com bust, the 2008 financial crisis, and even the COVID crash have shown how brutal and unpredictable stock markets can be. But unlike property, stocks are liquid. You can sell them in minutes if you need to rebalance, cut loss, or simply raise cash. There's no waiting months for a buyer or paying hefty legal and agent fees just to exit. Besides that, stocks can be as diversified as you want them to be to reduce your risk. You can invest in the S&P 500 and spread your risk across 500 of the largest US companies, or go broader with a global ETF like VWRA, which gives you exposure to over 3,600 companies around the world. You can even add bonds, gold, or other asset classes to balance out your portfolio even further. But more importantly, you don't need to take on massive debts just to invest. No 30-year loan, no stress about interest rates. You can dollar cost average into ETFs at your own pace with far more flexibility and definitely far less financial pressure. In short, whether you choose to go all in on property, stocks, or a mix of both, just remember this: your money is your tool, not your boss. It should give you freedom, not anxiety. It should open up options, not lock you into a lifestyle that you can barely afford. So, before making any big financial move, whether it's upgrading to a condo, DCAing into ETFs, or building a multi-asset portfolio, ask yourself this: is this decision helping me to build a life that I want, or trapping me in one that I will potentially regret? Because at the end of the day, it's not just about growing wealth, it's about growing control over your time, your choices, and your future. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.